Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, March 1st, 2022. What I'll do is a brief update on the equity markets. Also want to do an update on gold, silver, and U.S. Treasury bonds. Speak a little bit about what they're telling us now, and those were also a trade idea thrown out there recently. So let's dive into the charts here. This is NQ, the same chart. I got these out to you guys this morning. The futures I did in the video yesterday showed you we had these nice looking bearish rising wedge patterns on the 60-minute time frames of the stock futures. And so there was your sell signal today. We had a breakdown, a little back test, snapback rally, and we're moving lower. So when I got that post out to you, I said this was the first support, and they were all there. But it's what I do. I give you my thoughts, right or wrong. I said I wouldn't try to game it, even though we could bounce. There was a little reaction there. Reaction I define as a bounce and/or a consolidation. So this is a 60-minute chart. You should be able to make out in the video. There's 1, 2, 3 consecutive candles. The first one we hit it, and then we traded there for the last few hours. So and now we're below it. So that's what I expected, and hence, well, in hindsight, so far, we'll see if it worked out. But why I didn't care to, game a bounce as an active trader. Remember, I speak to you guys wearing multiple hats: swing trader, trend trader, active trader, day trader, and for the most part, I try to keep the day trades, those ideas light. It's just impossible to follow. By the time I get anything out to you, usually you close that trade out and probably reversed it. But every now and then I'll show you some opportunities. So where we're at now, look, where do we go? My thoughts are, and I kind of said it in that post this morning, the intermediate term trend, the NASDAQ 100, which is where my main focus on, had topped back in November, small caps and other things, S&P's following. And any one of these seemingly, short-term sell signals very much has the potential to be the end of a counter trend rally in the next leg down. Let's just, again, let's not forget the stock market is clearly in a downtrend. And this is what it looks like when you go to the 2-hour chart of NQ, NASDAQ 100 futures. And you see we're making lower highs and lower lows. And so I spoke to this the other day. You're going to see very powerful and what may be to some seemingly impressive rallies, and and impressive whether you're new to this or not. But we saw, what was it, about a 7% rally in QQQ the other day, in the last couple days leading up to that. But again, it did absolutely zero, meaning nothing technically, because you have just simply making stair-stepping down. That's what a downtrend is. Looks like a set of stairs. It's a series of lower highs and lower lows. And so at this point, what I've been saying, you need to take out the most recent lows to open the door and sharply increase the odds. Because again, when you're still coming off those divergent lows, so maybe this is just a little pullback and we go up. And I've already shared what will start to concern me, and that's if and as each of the indexes, let's mainly QQQ or here NQ, the futures, and the S&P 500 via SPY and ES, if they start taking out those previous highs and Fibonacci clusters and everything else. So let me move on, because I got these out to you this morning to show you what it looks like. Nice move so far. If you shorted the breakdown or re-entered, added, whatever you call it, day trade, you're good on ES for about 1.8%, and then on NQ, which I was just on, we're zoomed out here. Nope, I got to go back to show you. I had those wedges on this 60-minute time frame. So let's go here. Oh, nope, that doesn't do it either. Let's go to 1 month hourly. It's going to show me that chart. There it is. So that's good for about, they're both a little under 2% so far. And then last but not least, just to kind of update them, RTY, since the breakdown, RTY, you also had a nice back test. You had, if you missed the breakdown here, you had a nice back test to back test that trend line I gave you yesterday, as well as a back test of the wedge. And then if you took that short there, let's just say you're good for about 2.3% so far, still at support. And there's another example. Got those out to you. RTY, which is a small cap ETF, same as IWM, which is the ETF version. 1, 2, 3, now 4 hourly candles. So we need to break that. Otherwise, this could be it. Could be the end of the pullback, but Again, for the reasons I stated, I think we'll probably continue lower from here. And if you're unsure, you don't like the back and forth, then you could always take quick profits and then add if and when either this level's clearly taken out, or again, really where I see the waterfall selling. Even if we get close to the recent lows, I think that's where the market will start to really move down sharply if that happens. And of course, I trade multiple time frames and multiple securities. And even if I'm not trading multiple securities, which I should be more correct on that, my preference is often NQ over QQQ, just like the futures. The leverage they afford and the liquidity and the fact that I can trade 24/7. If 3 in the morning something happens big in the markets and I'm asleep and I have stop loss orders, they're gonna be covered. They're gonna be hit in a liquid market too, a fairly liquid market. 3 in the morning, obviously you don't have the same liquidity that you have at 3 p.m. in the afternoon, but enough that again I don't have to worry about gaps up and gaps down unless I take the futures home on the weekend. QQQ gave you what was just a nice looking sell signal. That 0.53 level, went over these yesterday. Each and every time the PPO has gotten up and crossed that level or kissed it, we had tops ranging from little tops, little pullbacks to bigger tops. And this version of the chart, I have the divergences you can see. So that divergence marked a bigger top that walked us all the way down here. You had a divergent low, and then little trend line breaks too. And so this was the same trend line break. This was that bearish rising wedge I gave you in the futures. That's the same uptrend line there, right there, off the recent lows. So you can see what's taken out. And again, another, so far, not much of a pullback, but certainly a rejection right there, right at both the downtrend line that I had laid out yesterday, as well as the push up to that 0.53 level on the PPO. So the pattern so far continues to work. And if you took that short, one thing you could do is just put a stop above the recent highs, because to take it out means you're going to take out both the trend line and then this signal. This is no longer working. So far, it's been good for at least minor pullbacks. And even if you shorted that one, you never took out the high there. You were still below. So that short entry there, if you held on to it, you're still profitable. Even that one right there. Okay, and let's talk bonds now. TLT, it's the 30-year bond on Treasuries for ETFs. They range, it says 20 plus year. They target the long bond, which is a 30-year bond. Sometimes you have bonds that are, not issued today. You take one out today, it's 30 years. A year from now, it's got 29 years left on maturity. So they'll roll in. They keep the long end of the bonds there, long end of the yield curve. And you can see, I showed you the other day that we had CB with positive divergence, and the CB of the bond futures I'll get to in a second. We had nice support here at 134.70 on TLT and a downtrend line. Well, since then we held and reversed off the support as was expected, and also took out the trend line. This is one of the biggest moves up in treasuries in a while. Remember, everybody had left treasuries for dead when it started becoming clear to the masses that the Fed was going to raise rates. And I kept saying, well, look, yeah, short-term rates will go up undoubtedly. And again, in my opinion, Powell is almost criminally behind the curve on raising rates. All he's done so far is just talk about raising rates. He hasn't raised them, and now because of Russia and Ukraine, there's talk that everyone's backing off the expectation for a possible 50 basis point hike. Anyway, here's the thing. Inflation is here to stay, and inflation should... There's counter arguments here. Inflationary environment is typically bullish for bond rates, bearish for bonds, meaning it makes bond prices go down, and they have over the last year or so. But there's also the deflation argument, and deflation is when you have an inflationary environment with stagnant or negative growth. And so that would be a worst case scenario for the economy, and that's what I think is a very likely scenario. We have hyperinflation. You keep hearing on the media that the inflation hasn't been this high in over 4 decades, but even back then it wasn't even close to the rate of acceleration right now in inflation. It gradually crept up through the 70s and into the early 80s up to where it was at the rate it was increasing. So what we have here, the brakes need to be put on this. And now, as I and other critics have talked about, the Fed was just too easy for too long and got so complacent with the fact they can just gun the stock market and create, the wealth effect. And what they did is they didn't realize they needed to be a little more judicious with that, and they should have reined it back in after COVID when they saw everything was hunky dory. But they didn't. So they backed themselves in a corner now. And so now you have everything going on. Oil surging, breaking $100 a barrel. I'm watching palladium shoot up because Russia is one of the biggest producers of the platinum group of metals, which includes palladium, platinum, and those are used in emissions controls for cars. So see, none of this is going to can't be fixed. So Powell on one hand doesn't want to raise rates because the markets are getting banged up pretty bad. The U.S. markets, we're still not far off those lows, and by my projections probably have a lot lower to go. But on the flip side, if he does nothing, keeps rates low, we're going to have runaway inflation, and things are going to start to break here. It's just not good for the economy. So anyway, right now I just want to say that Treasury bonds are coming up to some resistance here. You have a reaction low. Let me put a line there for you. If you took TLT or also on ZB, consider that you have this little W pattern here. So you have the top here, you have resistance, and you back tested it here, you hit it there, you hit it there. So we're at resistance. We didn't have positive divergence. I wasn't looking for a runaway move in TLT and ZB. I just want to say we've had that bounce so far, and I think, I did. I showed it to you on the weekly, and it really stood out to me on the weekly. Look how good that support is, 134.42-ish. Resistance here, giant breakout candle right there. Successful back test, and this was the first time we fell to it since back in early-ish 2021. And so it was just a bounce. And now look, that's my first resistance level, about 141. We're right there now. So we could move higher, but again, I don't have strong convictions right now, and I think I said that on the last update. It's hard to say how much farther, for me, to say how much farther TLT is going to go. I want to show you one thing regarding the yield curve, but before I leave this chart, let me go to ZB. Those are the 10-year Treasury bond futures. Got it on another board. They rolled since my last update, so all the levels that I had on the chart are gone. I had to replicate the chart on this program. When they roll, they don't keep the continuous contract going. They'll roll into the next continuous, which is the June contract now. But this is that divergent low I showed you. So we came off it, and it's been a nice run in ZB. It's up about almost 5% since that divergent low, continuing to climb. So what this tells me and tells us is that long-term rates are falling, and long-term interest rates will fall in one of two things typically. Either diminished expectations of inflation, but more so diminished future economic growth expectations. That's the biggest driver in the markets of long-term interest rates. And so please don't ever get short-term and long-term rates confused. They each can do their own different things, and now we're going to talk about that real quick. But I just wanted to say, if you're in the ZB trade, you can use it as a hedge to, or a pure play. You've got some next resistance up here. I'm going to say it's more of a range right there on the ZB. This again, 30-year bond futures. You can see these reaction lows right there. You also have a trend line that goes like that, connects these points, these reaction lows, roughly right about there. So that would be a max range. I think we're probably overshot this for now and probably come back in, meaning overshot that resistance on a lot of momentum going in. We might normalize there. But I want to show you one more thing here. Okay, so I talk from time to time about the yield curve, and the yield curve is the let me expand this up. My correction. This is not the yield curve. This is the spread. I'll show you the curve in a second. And this is a big one. This is what a lot of people that have been doing this for a while or do this professionally, they watch. They watch the bond market. Even if you care less about trading bonds, that's usually, yeah, I'll trade them. I've always said anything with a ticker, I'll trade. Sorry, I had to pause the video there for a second. Anyway, this is the spread between the 10 and the 2-year Treasury. Oh, you can look at spreads between the 10-year and the 1-year Treasury, sometimes the 30-year and the 1 or 2-year. But it's one of the most accurate predictors. An inverted yield curve, as shown here, has predicted the past 7 recessions with a 0% failure rate, I might add. And so what it means is this line here is 0 is when it inverts. And when the yield curve inverts, it means the yield or the rate that the 10-year bond is paying has then dropped below the 2-year. So you're getting better interest on a short-term bond, which is not normally usually rewarded longer. You're going to lock your money up, the higher rate you're going to demand. But what happens is because the bond market is usually has a little more foresight than the stock market, it is doing what I said earlier. It predicts slowing future growth, even though things may be hunky-dory at the time. The stock market may be at or near all-time highs, and usually is. And so you invert, and it's not an exact timing indicator, but when there's an inversion, hopefully you can see it here in the video, there's these gray shaded boxes, and they indicate, they show you the periods of recessions that we had. And so you can see each and every time we cross down below, and again, it wasn't right away. Sometimes it was closer than others. A recession followed. So these are all the recessions going back to the 70s here on the edge of the chart. And there was that one back from the financial crisis, 2007 to 2009. And here was the shortest one on record, in a long, long time at least. It was just 1 quarter. And there was the yield curve inverted. And that was before COVID hit. And this is what, again, I gave the nickname to what happened back in March of 2020 is what I call Ursa Interruptus, meaning it's my rough Latin, not fluent in Latin, but those 2 words I can put together. It means interrupted bear market. We were by all accounts, COVID or no COVID, I believe the U.S. economy was headed for recession. And look, guys, I don't wish those things on the economy. It's just a natural part of the business cycle. It's just like the seasons that we have, winter, fall, spring. You're going to have these things. Things ebb and flow. And now sometimes they come closer to each other, especially when there's a lot of intervention by the federal government, but they're very necessary. They purge out. What they do is they clean out the excesses, businesses that shouldn't really be around. They prospered, in boom times, everybody's making money, but then it leads to too much competition. If you sell widgets in ABCville, USA, and you're making money, your family-owned business for the last 50 years, 100 years, and all of a sudden everyone will realize, hey, you know what, they're making a lot of money, I'm going to open a widget shop. Now you have 20 widget shops in ABCville, and guess what? Nobody's making money because everyone's trying to undercut each other, and then what happens is recessions come, and those that are really running a sound business model, with low debt and good handle on their expenses, those companies will survive. So when the recession's over, they come out and they emerge much stronger. So that's what happens there and you need them. And what happens is when the longer the federal government, they kept taking rates lower and lower to prolong the inevitable, the worse it's going to be. I hate to say that, but eventually it's going to be an ugly one once we get the next real recession. And that's going to happen when the Fed runs out of bullets. And again, they're right now in a very box in the corner. So that's it. Anyway, there's the yields on the 2 and 10 year. I just wanted to mention, okay, where am I going with that? Well, okay, that wasn't obvious. Look at this. Okay. Pretty clear where we're headed. And we haven't inverted yet, at least not on the 2 to 10 year. And by the way, this is probably, I believe this is an end of day update from yesterday. We are at that big, Treasury is up again big today, meaning the long-term yield's falling. And so what we know for certainty is the Fed's going to have to raise rates. What's going on, depending on how bad things over are in Europe, maybe a little slower than faster, we'll see, only time will tell. But again, what's going on there is actually making it worse and harder for Powell and the Fed. Oil's skyrocketing over 100 a barrel. There's a number, and I forget what it is, for every X amount of increase in a barrel of crude oil, it has a Y impact, which is obviously a negative impact on GDP in the economy. So we know what surging oil prices can do, especially when they hit that level. Going from when they went from 35 to 40, 45 a barrel, even in percentage moves, that was a big move. It didn't really do much. You were still happy getting your $2 and something cents gas at the pump. Now you're looking at gas approaching and exceeding in a lot of areas $4 a gallon, coming up on even in some parts $5 a gallon, and there is a very negative feedback that starts to accelerate on the economy. And again, the metals, industrial metals, commodities, wheat exploded. Ukraine's a big producer of wheat. I think I mentioned that recently. And as I mentioned, Russia with a lot of other things, including oil. Russia's one of the world's biggest oil producers. So this is just not good, and I'm surprised the markets are really shaking it off as much as they have so far. But let's watch this. This is just something I wanted to point out. You can see here's the Treasury yield curve. I told you I'd show you that as well. By the way, you can see the site. Guru Focus is the one I'm going to for this information. It's just got nice layouts here. Here's the current yield curve, and you can see it's going up. We know these short-term rates are going to go up. This is what's going to go up undoubtedly, right? Because the Fed's raising. See, here's where it was back in February 2021, right here, a year ago. See that? We had short-term rates up there. Powell's going to have to get past that point. The Fed will soon. So you're going to bring the short-term up, just like it was in the gray line here. That's what it was in 2021. And the long term, if I am correct, and because raising short-term rates is going to stifle economic growth. That's why the Fed does it. That's, if you're curious as to why the Fed has to raise rates, it is to slow down economic growth, because inflation is a big risk to the economy when it gets out of control, especially to the majority of Americans who are not, they're living, not necessarily poverty level, especially those are the worst. But the lower they are down on that spectrum of income, the harder inflation hits them. If you're making 6+ figures, you can afford $4 a gallon of gas. You can afford, to pay a little bit more, for your milk and eggs and everything else. It's that class can't. Especially you can afford it when, as the government's been doing, they've been gunning the stock market intentionally to create the wealth effect. Well, that does no good to a family of 5 living just above the poverty level, because they don't have a 401k. They don't have a lot of mutual funds and ETFs and Apple stock and all that good stuff. So that's the big problem going on here. And so if this we know with almost about as much certainty as we've ever had in the financial markets, we know this ends going up. The short-term rates, when the Fed raises, will raise this end of the yield curve. And then the big question is, what's going to happen here? Will the longer term, will people think that we're still going to have inflation 30 years out? I think not. Or more so, will the decrease in economic activity and possibly recession bring down long-term rates? And if so, all you got to do, that'll invert the yield curve. And that's, again, this is the one. That's the 1 month. I'm sorry. This is the 2-year right here. So there's the yield curve we were talking about. There's the 2-year. There's the 30-year. This one right here shows the spread on the 1 and 10-year, and you can see the same thing. It's turning back down. We had an inversion there, and it's hard to see in the video. There is a recession line right there. Again, brief recession, and you can see all the other ones that happen. So we'll watch this. Maybe it inverts, maybe not. Maybe it inverts in it for the first time in many decades. We get a yield curve inversion and we don't get a recession. Anything's possible, but I just wanted to point this out because, again, I talk in probabilities, not possibilities. Last but not least, update on gold. I'll be relatively brief. I've been very consistent and persistent, persistently bullish on gold. Also recognizing and stating we've been in a year or long consolidation range, what I believe to be a consolidation range within a bull market. But what's not my opinion, only time will tell. If we take out the old highs and continue on, as I suspect, then that opinion will be proved to be correct. But what's factual, and I've been pointing out for months now, is this symmetrical triangle pattern on GLD. And what's factual is we broke out above it a couple weeks ago. So the lines are well enough defined. We had breakout candle follow through, and I've maintained since that breakout, you want to be in buy the dip mode. So this pullback recently, gold dropped 4%. That was the biggest drop since the breakout. That was a great buying opportunity. You can see here you had a nice gap to come in at on GLD, and you could have bought that gap. So until unless that breakout fails or things fundamentally start to change, I'll just keep it simple. Gold is a buy the dip. It's a long-term, back into long-term trend investment trading mode, and that goes for the miners and as well. Of course, you get more bang for your buck. They're just more volatile. And then silver as well. I talked about silver breaking out, and here's the daily chart. You had this downtrend line right here, right? You had a positive divergence below. You had a breakout recently. You broke out and you pulled back, and you were given a gift. The gift was a back test of the trend line. So if you bought it right there just a couple days ago, it rallied about 6% off that level. This is bullish price action to a T. A breakout. You had impulsive rejection, little fears. I think that's probably when the euro tanked with everything that's going on, and was a buying opportunity. As I said, buy, at this point, after the breakout, until and unless it fails. Now, I'll recognize, if it fails and the breakout in gold fails, well, I'm not going to be telling you to keep buying the dip. Do what you want. I'm not going to be myself looking to add to positions on pullbacks like that. But so far, that is a breakout, a back test. Yeah, volatility's high in everything right now. So if that big drop scared you and you said, oh, that can only be the start of something much worse, it's just like what happened in the stock market. Don't read too much into any big moves unless they're technically significant, meaning a breakout above or below a very important, very well-defined support or resistance level. Then a big move in the market, especially if accompanied by volume, is technically significant. Other than that, I just view it as noise, within a high volatility period. And so there's SLV. Again, that's the silver ETF, and this is what it looks like on the weekly. So this is where really investors and trend traders focus, and shouldn't even get caught up in the noise of what goes on day to day. There's a trend line, but that's your divergent low. There's your wedge. There was your breakout, and so far so good. And we're coming up, and there's resistance about 23.83 right there, and if and when that breaks, and which take us up to run at and test those previous highs, and once we break out of that, if and when we break out of that, that's going to be bullish. But let's first things first. Let's just say the very near-term outlook remains bullish at this point in time. And like I said, it helps to see the dollar falling and the euro rising, but it's not necessary, as I told you before. The most important thing if you're trading gold and silver is what gold and silver are doing. And there's a takeaway that I have, that if the euro is falling and the dollar is rallying, as it has been recently, including today, but yet gold and silver go up, that is very bullish to me, because gold is offsetting the impact of a rising dollar. Because a rising dollar usually brings down the cost of gold. So that's it. Those are the three core things. Well, the Treasury bonds, like I said, were kind of an in and out thing. If you're in it now, you can trail up stocks. I also talked about, which we've gotten, it also shows you, by the way, that TLT, I sat there and talked all about inflation and interest rates and all that good stuff. The other component, this is still the king of, always has been for years, the king of risk-off assets, meaning institutions will flock to treasuries when they anticipate market volatility, or once market volatility happens. Quite often I've seen these kind of moves into treasuries. Remember, the stock market, is off the lows, had a nice rally recently, yet treasuries are moving up. So this could be attributed to, as much as anything I said earlier, it could be attributed to institutions moving out of equities. Maybe retail traders, aka the dumb money. Hey, put me in that category if you want. That's just the name given to the retail traders. Smart money are the institutional traders. That big pop that we had recently in the stock market, especially in the beat down tech stocks, there's that huge green candle, maybe sucked in a lot of retail buying. I don't know. I don't have that level of data access to it, so I always have to infer from the charts. I have little doubt that a lot of retail traders did step in once they figured it was safe to come back in the water. And the point is that I'm getting at is you're seeing treasuries moving up all the while. So it's usually not the retail traders. How many of you or your neighbors or friends or family talk about trading buying treasury bonds? Very few, very few. So it's usually the institutions. So we see treasuries moving up. And so they could be passing off, distributing, getting out, taking advantage of the bounce in equities and moving that money over into treasuries in expectation for what could be that next big leg down. So you all know my targets, where they're at, and you know where we're at. I'll just wrap it up here on the weekly chart. Nothing has changed now. So when we first hit that target back there, what is it now? The week ending the January 28th, so the end of January, we hit it. We had the expected bounce right back to the 200-day moving averages, and we've been testing that level now for the last almost 3 weeks, and here we are right on it. So this is where I still favor, but I can't say it with the utmost conviction. But once we get down there, and again, we'd be so close to that second target, and I think all eyes will be looking at that low, but I think even if we start to get close to that low, let's say around this point here, that's probably where you'll just see the bottom fall out and then a quick move down. And it's still, bear flags are still potentially in play. I told you before, one green candle, just like you had one green candle here on the way down, is acceptable. We could continue on down, and the bear flag could still play out. As they usually do, with an impulsive leg down followed by a period of consolidation and another leg down. And hey, if it doesn't, these aren't the be-all end-all. It's just one pattern that I pointed out that may or may not play out. And if it doesn't, there's a lot of scenarios, but one would be we consolidate for a while and still be a bearish scenario, but remain under the 200-day moving averages, or most importantly under that 379-ish level, 380 right there, and then have another leg down. That would just be a longer top, but I'm still leaning towards a relatively quick move down. And here's the thing: today is Tuesday. The day is getting close to being over. We've got about an hour and a half left to go in the trading day, and so we'll probably know by the end of this week if that sell signal we just got today on the shorter term charts, or really the entries yesterday, we rallied into resistance. You could have took it when QQQ hit that downtrend line and give you that PPO sell signal. If that pans out, that could get us down here. So we'll see. Every day is different. Like I say, the charts are dynamic, constantly changing, and therefore so is my analysis. So I'm going to end the video here, get it out to you guys, and we'll see where we go from here. This has been Randy Finney with Right Side of the Chart. Have a great day.